These 90 days, I've seen you've been tweeting about this nonstop. I don't think a lot of people understand what is a 90 day and why is it so important to understand?
Yeah, first off, they're rare, but thank you for having me back. I appreciate this. So that was last Friday, right, when the Fed, you could say, turned a little more dovish. We took a look at 90 days when 90% of the stocks on the New York Stock Exchange are up and when 90% of the volume on New York Stock Exchange is up. This is super rare stuff. Like the last couple we've seen, we're coming off the COVID lows in March of 2020, and then just this recent April. So they're extremely rare. We just had one last Friday. Okay, well, what does it mean? Normally, they happen after weakness, and it means the weakness is over, right? 11 of 12, I went back to 1980 using data from our friends over at Ned Davis Research. Only 12 times this has happened, all right? A year later, higher, 11 times, up like over 23% on average. No, I'm not saying 23% a year from now, but these clues that we see are worth listening to. And one more thing to build to this, when we looked at it, it was amazing to us how many of these 90 days took place with a major shift, meaning like early 2000, when the Fed makes a change or when there's an interest rate policy change or some like major thing out of Washington. Well, again, we just had a major change, we think, with the Fed coming more dovish. History to repeat itself. It often rhymes. Mark Twain. I think this is a bullish event.
Now, that is specific to the U.S. market, but one of the things I've also seen a lot of people debating is whether we are in a global bull market. And so the U.S. has done very well over the last few years. I think emerging markets have kind of been lagging behind other markets. People are kind of saying to themselves, hey, should I actually be looking there? Are they cheap stocks? How does that going to compare to the U.S. outlook? How are you guys think about a global bull market versus just a U.S. bull market?
Yeah, I don't know how you can even argue at this point. I think we're in one, right? I mean, I felt like 39 different stock markets, like they're all higher on the year. Okay, so that's just one way to look at it. But we look at like Europe. I mean, Europe is breaking out above the peak from 2007. I mean, European stocks, as most listeners probably know, haven't done much for a long time. Well, they're taking the baton a little bit this year. Now, we still in the U.S. is just fine. We like the U.S., but the way we're managing the billions of dollars my team manages, we have some equal weight to developed international, specifically Europe. We have a little bit of emerging markets. We don't like emerging markets quite as much, but nonetheless, you look around the globe, there is a lot of strength. Because again, the last couple years, what happened? U.S.-led, India-led, and Taiwan-led. Okay, that was about it, honestly. Now we've got leadership coming from all over the globe, and I think that's a really good thing from a diversified portfolio point of view. Because again, last comment here, the U.S. isn't going to lead every single year. That's just how it works. We like the U.S., yes. But again, this year's a perfect example of why you'd keep a global diversified portfolio, again, tilting overweight to equities. That's how we've been doing it all year, and it's been working nicely.
Now, when you start to look at, let's say, Europe versus maybe other places internationally, why is it Europe specifically? Is it just because you're looking from a technical basis? Are there other drivers that you're paying attention to, maybe central bank actions? Walk me through kind of why Europe specifically is so interesting.
Absolutely. What is Sir John Templeton, this time is different, the four most dangerous words? Well, one thing that caught our attention coming into this year, maybe let's call it around February, March, Germany came out and said, hey, we're going to have a massive fiscal plan, right? I mean, that's not something Europe usually did. And we kind of looked at that and said, okay, there's something changing here. Again, you can argue it's some of President Trump's policies, to be honest. Everyone told us how bad tariffs are going to be for the global economy and how bad it's going to be for different countries. Well, the exact opposite's honestly happening. I mean, just look at the numbers, right? And again, now that we have Germany and different parts of Europe kind of doing things on their own. They're stimulating their economy on their own. The start of the year, Europe is supposed to be 0% growth, US 3%. Well, now we're looking probably 2% each of it. It's all about expectations. And we think, again, maybe a little more upside in the growth in Europe specifically is a reason to have probably a little bit of allocation to developed international here.
Now, when the ex-US index is surging, does the U.S. draft off of that? Like, is there a world where when the U.S. goes up, they pull everyone else up with them, and there's kind of a sloshing of money around the global economy? And then vice versa is also true. When everyone else leads, the U.S. should catch up later? Or do you look at these as kind of separate and distinct economies and stock markets, and there's not really that big of a relationship between the two?
Yeah, I'd say separate because honestly, last couple of years, U.S. was up a lot and the rest of the globe, it really wasn't. I mean, you could argue there's some years they go together, but I think the big thing that we have is we know at the middle of the year, U.S. is up 8 or 9%. Most European markets up high teens. With the U.S. plays catch up, but I don't think we're catching up with Germany's over 20% gain. I mean, Mexico's up like 24, 25% on the year. That's not what they told us on TV a couple months ago when all this stuff started. The way the U.S. plays catch up, but doesn't totally catch up, in terms of the absolute return by end of the year.
Now, there's going to be a lot of people who are watching this and say, hey, I really like what we're saying here. My whole portfolio is in the United States, Mexico, Germany, other places. How do I do that? Right? Is it a countrywide index? Is it I got to go and set up an account on one of these stock exchanges internationally? How are you guys working with your clients in terms of, it's one thing to identify from like a data standpoint, say, hey, Germany's interesting, Mexico's interesting.
Yeah, great question there. I mean, we use a lot of those big ETFs. I'm kind of limited what I can mention, but it's not too hard to find them, right? There's developed international ETFs, European ETFs, emerging market ETFs. Like you mentioned there, world ex-US ETFs. I mean, honest to goodness, that's the easiest way to do it. Go 10 or 15% in one of those global ETFs that's ex-US, and you're going to get a lot of international exposure, a lot of emerging market exposure. Some of the we're not warm and fuzzy necessarily in the foreign, kind of some of the smaller foreign markets, but they are really, really exploding higher as well. So there's just so much global strength out there. That's an easy way to do it.
Now, I've seen you talk about hidden inflation risks, maybe specifically related to the stock market here in the United States. What are you guys seeing there?
Yeah, but that's one of the things that we've kind of come out at, that we don't think the Fed's going to cut quite as much. I think a Fed cut's coming. I mean, one thing for listeners, when the Fed cuts near all-time high, a year later, the S&P's higher 20 out of 20 times. They're going to cut in September. That's hopefully a good sign to think about. But when we kind of peel back that onion, we know goods services are trickling up a little bit because of tariffs. We all get that. And what did Powell just say last Friday? It's probably a one-time tax, a one-time jump in pricing. We agree with that. We said that all year. But all of a sudden, services pricing starting to go higher, right? The producer level, PPI, had an 8 sigma event in terms of how much that beat. Just keep it simple. It's supposed to happen once every 6.2 billion years. It happened 2 weeks ago. All right, so we're not saying inflation is coming soaring back, but if something we're watching very, very closely, because I work with a real smart guy named Son of Our Geese on our team who really dives into this stuff. He's been saying for a couple months, there's a couple things in inflation he's not too warm and fuzzy about, but the honest truth, the labor market's been slowing down a little bit more, and that's why the Fed said they're going to cut. Probably going to cut a couple times this year, and all in all, hopefully the market likes that still.
Now, that inflation, are we able to pinpoint what's driving it? Is it the tariffs that are driving it? Is it monetary policy? Is it something else? Like, how do you start to identify what is the source of the inflation? And does it matter? Or is it just, hey, inflation is going to be back and that asset prices are going to go higher?
Yeah, a lot of levels to this one. I mean, like frozen vegetables are up 40%. Okay, I mean, I'm not saying that's probably a one-off thing, but you've got these different things that are taking place. Honestly, though, when we look at, you can look at like, go to St. Louis Fed, pretty easy website, public website you can use. You can look at like CPI, right, consumer prices, and look at services and look at goods. Well, goods been trickling higher, but services have also. Services is a very, very big part, and that's a part that, again, has caught our attention. Now, the other side of this, I think you were going to talk about housing in a second, but shelter has been kind of pulling back a little bit for a while. We expected that to pull back on inflation, and again, it's kind of evening things out a little bit, and I'll put a bow on this. I don't know if people are going to listen to this, but on Friday morning, we get the Fed's favorite measure, inflation, so they tell us, the PCE. We'll see what happens with that, but again, that's going to be really important because that's been trickling higher. I believe it's 4 months in a row now. It's been kind of inching higher, and we'll just have to dive in and see what it does.
Now, one of the things about inflation that I always get a good kick out of is inflation can go up, but it can come in lower than expectations, and people will celebrate that. Now, how do you guys look at the relationship to the expectations versus just the raw increase or decrease of the inflation number?
That's a great point, because what was inflation? Like 9-10%, in the summer of 2022, and then it started going down to 7%. Oh, 7% inflation, but the market loved that. I mean, the thing I've learned in the 25 years or so I've been in this industry, markets don't care about good or bad. Markets care about better or worse. Markets care what's priced in, right? And again, that's why you have these big rallies, even though the data's not great sometimes, because it's better than expected. That's why we just had this rip-roaring almost 30% rally off those lows in April, because everybody was telling us it's going to be a recession. That was telling us we're going to have massive inflation because of these tariffs that are coming in. And that's not been the case. And that's, again, why we're literally hitting all-time highs globally the time we're doing this. So I think it's more about those expectations. But the good news, hey, have me back and we'll talk a little bit more about this inflation if we continue to see problems.
Now, you mentioned that housing is pulling back a little bit. I think that we have seen home prices drop for 4 straight months, which is interesting because all I see in the headlines is how unaffordable housing is, which both things are true, right? Homes are very unaffordable. I saw a stat recently that if you go back to like the 70s, people used to have a home price that was about 2.5 times their income level. Now it's 7 times. So there's a very material increase in the relationship between how much money somebody makes, what the cost of a home is. But it has been going down for 4 months. So is that progress, or is this not nearly enough to make a dent in kind of affordability?
Yeah, I think it's a little bit of both of what you just said there, because the honest truth, we know with interest rates where they are, we were in the opinion back in January, February, the Fed should have been cutting. And then the tariff stuff started. The Fed had to kind of be on pause. Now we're looking at the second cut in September, 2 years in a row. The reality, though, again, is the Fed cut a couple times last September, November, December. What did interest rates do? They went straight up. Kind of not quite what you'd expect to happen, but that is exactly what happened. So where we are now, we do think the Fed should be cutting a little bit. You talk about the economy, consumers okay. Got a bunch of retailers coming out this week saying the consumer's pretty darn good. All in all, you can always pick pockets of weakness. I understand that. We get it. But overall, consumer is still solid. But where are the weak parts of this economy? It's clearly housing. And we know why. It's because interest rates, right? Interest rates are probably still a little bit too high. Yeah, I've got some minor inflation concerns, but we don't need 4.5% Fed funds rate right here. So again, that's why the door is wide open. I mean, what's the market say? I'm a message of the markets guy. The market's saying we're going to get 5 rate cuts over the next year because it knows there's a new leadership in the Fed coming in May next year. And it's probably going to be somebody dovish because President Trump gets to pick it. So we'll see. But the market's going to start sniffing that out, in our opinion. And again, that's where probably some lower interest rates are coming. And that's going to help that housing market in a big, big way. Help some of that affordability when you look at your mortgage and say, oh, my goodness, I can't move to the house. But hey, you take off 100 basis points, that's probably going to make a big difference.
Now, what's interesting to me is as the stock market has gone up and asset prices have gone up, investors are celebrating. They have exposure in their portfolio. They're making more money on paper. That's a good thing. You would also expect, though, investment bankers, companies, and investors to be demanding, pulling companies through the IPO process because, feed the ducks while they're quacking, right? If everyone's all excited, bring the companies public. We haven't seen that many IPOs yet. Doesn't mean we won't get them, but so far this year, we have not seen that many IPOs. But you shared a data point recently that said the average IPO company is up 35% on their initial day, which seems pretty good, right?
That seems really good. My friend Callie Cox at Ritholtz who did that data there. But yeah, we haven't seen a ton of IPOs, but we all turn on TV, and the ones that have happened have really, really done well. So you got to think, you look around, a lot of other companies are going to see that. We're going to see that. But you talk about markets, like, yes, people are feeling pretty good, but I travel the country all the time and present and talk and do industry events. I'm telling you, Anthony, people are not wildly excited. I mean, this is not like late 2021 or other times when it just felt over the top. Just today, we got something called the AAII Sentiment Poll. Hope I get it right on record this live. American Association Individual Investors. There it is. Sentiment Poll. All you got to know, 4 weeks in a row, more bears than bulls. We're hitting all-time highs, okay? I mean, so we're not seeing over-the-top optimism, which from a contrarian point of view is quite a quite positive thing. And honestly, if we start seeing a ton of IPOs, then I'll start looking around wondering, we're getting a little kind of late 2021-y with a little too much excitement. We're not there, which again is, I think, structurally bullish.
Now, when you see more bears than bulls and we're hitting those all-time highs, does that tell you that that's where the market's made and actually we've got a lot more room to run? Or do you start to say, hey, wait a minute, maybe the quote-unquote masses are right and they're all of a sudden woken up and they're smart and they say, hey, right around the corner is a crash?
Well, I'm going to take the opposite side, which is the masses are usually wrong, right? If everybody's thinking alike, somebody isn't thinking, journal patent. I mean, I still see a lot of trepidation. I still see a lot of worry. What's been fascinating, I think I talked about this before, though, off these lows, the retail crowd's been buying. Retail crowd's been fairly optimistic. It's the big hedge funds, big institutions that have been scared to death and been listening to too many of the scary bears on TV telling you how bad it's going to be. So I think it's really nice that the smaller retail crowd's done better. But even again, someone who works with retail crowd every single day with financial advisors all over the country, I never get asked I was in Augusta, Georgia yesterday. Great crowd, had good conversation. Trust me, nobody said, hey, this is great out there. How high is this thing going to go? I've never heard that question yet. And I used to hear that question, in the past life. So I think that's a comforting sign from a contrarian point of view. Expectations are low. We keep beating those lowered expectations. And I think this bull market keeps going.
Now, in the Bitcoin world, there's these 4-year cycles. And if you look at those 4-year cycles, we should expect, if they hold, somewhere in the October-November timeframe, that would be the peak of the market, which also happens to be around the same time that we peaked in 2021. And we kind of go down and we enter into a not so fun time for, 18 months or so. The stock market historically has at times followed. Obviously in 21, when we peaked, we then got all the interest rate increases and there was kind of a macro environment that really accelerated this. Do you think that the bull market, from a timeline standpoint, is it a hey, later this year we think is kind of it and runs out of gas? Do you think that this is like a multi-year thing? How are you guys thinking about not necessarily how high, but how long it
Those
can?
are great points there, because next year's a midterm year, and historically from a stock market point of view, midterm years are like the weakest year by far, right? So it's something that's in the back of our head we're thinking about. Also, markets don't always like new Fed leadership. There's usually some volatility around new Fed leadership. So you got that coming in May. Next year you got a midterm year. These are things we are thinking about, but to answer your question specifically, this bull market will be 3 in this October, right? October 2022. So this bull market will be 3. We looked at the last 5 bull markets that made it to this point going back 50 years. The average was 8, the length of 8 years. The shortest was 5, had an 11 and a 14. So I call this it's like a cruise ship. Bull market's like a cruise ship. They're hard to slow down, they're hard to stop, and they're really hard to turn around. Yeah, 100-year pandemic stopped it, maybe 4, and then we had the turbo war in 22, and interest rates spiked, and the Fed was way behind the 8 ball, honestly, I think, looking back. But the reality is this is likely a global bull market. It's a strong bull market in the U.S. that probably has many, many more years left to it, is how we see it. It doesn't mean every year is going to be up double digits. We just were up 20% 2 years in a row. Or up, high double digits now. I think we can get into the mid-teens before this year is over. One of these years might be a little consolidation. That's okay. But these structural bull markets that we are in last longer than you think. And the good news for investors, I think we're still in one.
I love it. My last question for you is stocks have done very well, kind of up and to the right. A huge reason for that, I think, is monetary policy and fiscal policy, where we basically just been printing money. We are now seeing things, we were talking earlier today about gold is held in central banks more than U.S. treasuries. We've seen central banks around the world outside the United States selling treasuries, buying gold. Do you guys read into what the central banks are doing or anything when it comes to gold treasury relationship?
Absolutely. A lot of banks, central banks, started buying gold in 2022, right? That's when we saw it, and in different times, they really, really started to buy it. The reality is we actually added some gold to the models that we run for our Carson partners back in April of 2023. Gold's up like over 50% since then. It's done amazing. And it's not like I'm some big gold bug. We just looked at the global dynamics and we said, there are times, one thing I was all over the place saying, there's been many, many, many years where gold and stocks have done really well together. I look at stocks like there's that 60% stocks and that 40% other stuff. Well, usually people say that 40% other stuff is bonds. We get it, bonds and cash. Well, we've said you should probably have some gold in there for many years now. I look at gold right now. It went up a whole bunch. It just went sideways for a while. It sure looks to me it wants to go higher. And if this gold bull market, it's in a bull market, ends like today, I don't think it's going to, it'd be like the shortest bull market we've ever seen for gold. These cycles, again, last a lot longer than you think. So we say this year, diversify your diversifiers. In a crazy world like we're in now, that's, again, that other 40% part. Has some Bitcoin, has some cryptocurrency, has some cash, has some bonds, yes, but also has some gold and some commodities. Makes a lot of sense to diversify your diversifiers.
I love it. Thank you so much. You're always fantastic. I learn something every single time we talk. People really love when you come on, so I appreciate the time. Do this again in the future.